Good day, and welcome to another edition of Stock Smart with Jeffrey Camus. This is the February 3rd, 2021 edition. And we're going to start right off with the Super Bowl of stocks. And it's definitely of the moment because we're heading into the Super Bowl weekend. So let's talk about what the Super Bowl of stocks would be. So let's look at the stocks of last year. So the four stocks that would be in my semifinals would be Tesla, TSLA, AMD, which is AMD, Etsy, ETSY, and NVDA. Now Tesla, for sure, it won the Super Bowl last year. It was up 743%. Next would have been Etsy, which is up 302% off the COVID mask business. Incredible. NVIDIA, 122%, and then AMD, which was up 100% last year. So the winner of the Super Bowl based on last year's numbers, the 2020 numbers, would definitely have been Tesla. But how are those companies going to do, and will they make the Super Bowl in 2021? That's the real question. That's what investors want to know. So let's take a look at it a little bit. You know, Tesla, it's moved so much, it's hard to see that it could do what it's done in the last year. It just doesn't seem likely. But it's still a great company. Analysts continue to lift price targets on it. It's been raised up to around 900 now for most people. It's growing its service business. So besides, it's got two ways to make money, or a double flywheel, if you will. So not only does it have the vehicle part, but it's also got the service side of the business, which I would love, by the way, if they're really coming out with it. I've put emails in. I put my email into the Tesla site for a solar roof. I would love it. I think my house might catch on fire, but I would love a Tesla solar roof if they're really working and ready. You know, I do believe Tesla is going to continue to grow, and it's got such a momentum crowd around it that it's going to always be one of those stocks that that people just fight for. Next up, let's take a look at Etsy. Etsy is a really interesting story for 2021. So in 2020, Etsy was dropping in business in March. They saw a decline because of COVID. So Etsy shifted its entire business, and they started really promoting the COVID masks, which were like handmade, custom, so that you didn't have to wear one of the blue masks or the traditional really ugly masks that everybody else was wearing. And Etsy saw huge growth, selling nearly 133 million in masks last year. And so, you really have to, laud a management team like that because of how they quickly shifted when they saw a different opportunity and they knew that their business was hurting. They looked, and that takes a lot of flexibility to do. Do I think it's going to go up 302%? Well, arts and crafts. I mean, it's a very popular, site. It's very unique. I do think it's a good stock, but I would doubt it would be up 302% again next year. Next, let's look at NVIDIA. Now, NVIDIA has grown greatly because of the growth in things like cryptocurrency. NVIDIA was the chip. If you look back a couple years ago when NVIDIA stock was blowing up around 400 and then it got shaved in half, it was because the crypto boom was in full effect. And NVIDIA grew because of that, because their processors were needed to create the crypto. And so NVIDIA grew because of that, and they continue to grow because of that. There's a lack of chips right now all over for all this production because everything in your house, everything you use has a chip in it. And do I think, being invested in some kind of chip, I think that's a smart strategy for any investor. Whether you want to just take the SMH, which is an ETF that covers a lot of the chip companies, or you want to be invested in a company like AMD. AMD did purchase a company called Xilinx, which is also a manufacturer. If you look at AMD and Xilinx over the last 4 months, the deal really is going to be about stock. So AMD and Xilinx, they move in direct correlation. If you take a look at it, when AMD is up X, Xilinx is up X. So take a look at that. We really like AMD. The semi-custom market's really interesting to me. Custom chips. They're making the chips for both the Sony PS5, the new unit, and the Xbox Series X. The PS5 sales are expected to be over 200 million. The Series X, the Xbox product, is still newer, and there's shortages. I would definitely be in AMD. AMD is a great stock. So as the gaming industry continues to grow, users buy, both the Xbox Series X One X game and the new Sony PlayStation game, we believe that's going to be a big factor in the growth of AMD. And that is going to be our Super Bowl winner for the next year. So you heard it here. That's a Super Bowl winner. That's our pick for 2021 AMD. So stock that someone asked me about, Blackberry. And I was like, seriously, the phone that people had back in the day to play Brick Breaker. And I never had one myself. I never liked the small keypad. My fingers are too big. But I would say this, if you like BlackBerry, go out to dinner with your friends when you can go safely from COVID and look around the table and see how many people have BlackBerries. And I think the answer is going to be like nobody. And it's staying alive basically because some businesses are still locked into their technology and their servers. But the business is in decline over the last 4 years. 23% it's down, and in its core business. It was part of the short squeeze at Wall Street Bets, and so it was heavily shorted, and it did bump. If you're in it now at 11 or 12, where it's at right now, it's a stock that's probably going to go back to 6. That's where the support is. So I wouldn't stay in it. It's dying business, not a growing one. Everyone is using iPhones or various versions. So I would not be in the BlackBerry. So that is not a stock I'd want, and I would get rid of it. So let's go into the Q&A section where I have a question from Christine. And again, thanks for the questions. You can send your questions to Jeffrey, Jeffrey, at Jeffrey Camus, that's JeffreyKamys.com, and getting 15 to 20, 25 questions a day. And I'm going to try to go through as many as I can. But here's another question, because this is so relevant to what's going on in the stock market right
investor.
Now. What is a SPAC? Definition of a SPAC is a special purpose acquisition company. It's essentially a shell company that's set up by investors, and the sole purpose is to raise money through an IPO. The SPAC then goes out and looks to purchase another company, and they have up to 2 years to do that. Generally, a SPAC will go public on the market or on the exchange at about $10 per share. Now, if you buy the SPAC, you have no idea what company the SPAC may choose to buy. So your money goes in, it goes in an interest-bearing account, and then the owners of the SPAC or the sponsors have 2 years to purchase a company. And so what's key in this, if you're going to invest in these, I wouldn't invest in these, but what's key in a SPAC is that you know how this works. So you need to know the management team. And if it's a management team that's had success with other areas or industries you like, that may be a reason to get into a SPAC. But if you don't know who the management team is and you just see the ticker on the bottom of the board, then you're making a mistake. So if you know the management team and you believe that they're going to have success in this SPAC when they buy a company, then, have at it. So what happens is, they have 2 years, they raise money. It's like they're going to raise money through essentially going public, the SPAC. The SPAC takes that money and then goes and looks for a company that may want to, have an IPO, but they're maybe not ready and they don't want to go through the process. So the SPAC essentially is a way for a company to go public, but through the SPAC. They're also called blank check companies. And again, you have no idea when you invest in it what they're going to be buying. There's a lot of people who want to get in these. The market's generating a lot of SPACs. It's like the most popular thing if you watch CNBC or one of the stock shows. SPACs are all over the place. I would tell you, if there's no company purchased in 2 years, and that rarely happens, you get your money back because the SPAC essentially has 2 years to purchase a company. But then they're also incentivized to go buy a company, and there's not the due diligence that a SPAC does compared to like if a company has to go public, like through the SEC, it's not even close, because you're essentially relying on the SPAC board members or the SPAC sponsors to decide if this company is a good company or not. So it's a buyer beware situation. Advisory firm Renaissance Capital found that the average returns from SPAC mergers between 2015 and 2020, by the way, it's not a new idea, it's just becoming in vogue right now. But those investing in those SPAC mergers fell short of the average market return for investors from just a regular IPO. So it's proven over the last five years or so that investing in a SPAC is not as good as if you find a company yourself and invest in it as an IPO. So that'll wrap it up for today. Have a great Wednesday. This is Jeffrey Camus signing off from StockSmart, February 3rd, 2021.